Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. It is 5:53 a.m. on the West Coast out here. And guys, honestly, I still get up early pretty much every day just because I want to be open when the stock market's open, to be just aware and involved. But this is the first time I've done the podcast in maybe a year this early. Like, I usually try to do it near intraday 11 or after close of market, just so we can have a real good recap. So today is early. This is really throwing it back for me. All these years ago when I started this podcast, I was adamant about getting up 4:30, and then the second 6:30 hit, when the stock market opened, I was ready to go. Okay, I had everything I needed. I was ready to talk, and it just seems so long ago. But here we are. Things have changed, and this week in particular, I've been excited. That's why I couldn't wait. I couldn't wait till the end of the day today. We had interest rate drops, okay, and that is a big deal. That's most of today. We're going to cover that. We'll get into the news. We're going to cover yesterday's close of day news and then what they're thinking is going to happen this morning, right? So our term of the day is the triple witching hour. Okay, now it's kind of a day trading term. I don't really like it, but it does have volatility implication. So this term is important for periods of the year. So there are investing theories that the first half of the year is better than the second half, and that during certain periodic trading windows, volatility always occurs, and there are just swing traders who try to ride momentum. So the triple witching hour is an important term for those people, and it actually does have volatility implication. Excuse me. So it's important, and it's coming up, the triple witching hour. Woo. The triple witching hour is the last 60 minutes of the trading day on the third Friday of March, June, September, and December, when contracts for stock index futures, stock index options, and stock options expire simultaneously. So obviously, when you have all these contracts, I prefer to call options contracts coupons. So when you have all these coupons come due, there's an expiration date, right? So that's when these things, it's as if the grocery store gave you a coupon, everything expired November 1st, right? Or October 1st. And so you have to get everything in before then for that coupon to be valid. So it's kind of a very surface level definition, but coupon helps me understand options since they can get a little complicated for the average person. But okay, guys, all I got to say is Wednesday and Thursday, wild days in the market, wild days. And most people, I'm going to cover the news here, but most people that I saw like on Wall Street Bets, Reddit, analysts in particular, they all think it's horrible for the market immediately, these interest rate drops. And we're going to go over some evidence that that's not necessarily true. And I was very adamant that these rates were not going to drop. I thought it was going to boost immediately to new highs. And look, we're not always right. Okay, I'll admit that. It's very hard to be correct even 20% of the time in this industry, let alone all the time. But this was one of the times where we were right, which is kind of exciting. So let me read yesterday's news, and we will go. We'll talk about today too. So after yesterday, this was the market close news. U.S. stocks soared with the Dow Jones Industrial Average closing above 42,000 level for the first time amid growing optimism that the Federal Reserve's jumbo interest rate cut will deliver a soft landing for the U.S. economy. The S&P 500 climbed roughly 1.7%, while the Dow rose more than 1.2%, with both indexes trading at record highs. The tech-heavy NASDAQ composite led the gains, up roughly 2.5%. Stocks rallied as investors took a closer look at the Fed's decision to kickstart its new rate cycle with a 50 basis point cut. They thought it was going to be 25. 50 basis is pretty aggressive. After Wednesday's policy announcement, the gauge swayed before closing lower. Wall Street has absorbed Fed Chair Jerome Powell's message that a deep cut into a relatively strong economy will ultimately fend off the risk of recession and is a sign of faith, not panic about current conditions. Bank of America now believes the Fed will go on to cut rates by 0.75% by the end of the year versus the 0.50 it previously forecast. So that means another quarter, right? Another 0.25, not another 0.75. That's a little confusing. By comparison, the central bank's own dot plot indicates policymakers expect a 0.5 percentage point reduction. Rate-sensitive growth stocks climbed with big tech mega caps that fueled this year's rally, making gains. Alphabet, Microsoft, Meta, they all rose, while Apple, Tesla, and Nvidia surged. Wow, we're talking like 3% here for some of these people, for some of these stocks. With the Fed pivot done, some in the market have returned to watching the data release as they brace for potential volatility. A weekly Labor Department report on initial jobless claims on Thursday morning showed a fall to the lowest level in 4 months. The figure for the week ended September 19th came in at 219,000, while the prior week's total was revived 1,000 higher to 231,000. Okay, so I know I read that pretty quickly just because yesterday was great. Okay, great response to the market or to the interest rate drops. Man, was Wall Street Bets very negative. People were saying fear, it's going to be fear selling, buy shorts, buy puts. What? These people, look, this is what I would say. And it's funny because I had this conversation with my dad in like 2017 whenever I was 1 year, or was I even a year? Yeah. I was a little bit over a year in the industry. And his whole thing was, well, all these analysts are saying sell Nvidia. So we had bought Nvidia at a pretty reasonable price. And I remember his thought process was, we got to sell. These analysts are saying sell, let's sell. And look, I'm a year in the industry and I still hadn't earned my family's respect to manage the money yet. So like we're talking, I'm a year in the industry. The firm is expecting me to get clients and I can't even get my own family because my family doesn't give handouts. We don't give that. The expectation is you're going to perform. So I had to really earn that. And I remember my dad being like, well, these analysts say X, Y, and Z. Like, I think I'm nervous. I'm going to sell. I'm going to do what they say. And the stock did go down. And then it went back up. Look, and my dad never used any of that money. Okay, all of that money stayed invested. And if he would have stayed in Nvidia, yeah, in that moment he would have lost, who knows, thousands of dollars. But now he would have millions. Okay, and it's a 7-year wait. So, I mean, that's the kind of thought process with these analysts. And so I bring that story up not to talk about specific investments, but to talk about analysts. Okay, analysts are motivated by money. So there's a term in the industry called a Chinese wall. And I don't know why they call it that, but that's what they call it. And the theory is you have Goldman Sachs, Morgan Stanley, JP Morgan, Schwab, anybody, Lincoln Financial, anybody. There is a research side of that firm that is just analysts, just financial writers. All they do is look at charts and look at analysis and data, and they make opinions about it. Their job, the rule is the investment side, the advisor side of Goldman Sachs or all of these banks, they cannot communicate with the research side. There's supposed to be this Chinese wall that prevents them. And maybe that Chinese wall in actuality is like 3 floors on a giant building, which I know is ridiculous. Like maybe the advisors are on the 9th floor and the research team is on the 3rd floor. So maybe it's 6 floors separating them, and that's quote unquote the Chinese wall. So with this data, please, everything, make your own analysis. Either pay someone or work with a financial advisor who does the investing. Okay, work with someone who does the investing and doesn't outsource it. Make sure everything's in-house. It's always cheaper, less expensive. Maybe not cheaper is the right word, but less expensive to work with an advisor who does everything in-house. It's less hands in the pot, and the advisor knows what's going on in your account. Okay, so I'm venting there, but the analysts, it's all just opinions. It is all just opinions, and it holds weight because there's fear in it. So that's why I'm reading Reddit. I'm reading Wall Street Bets. Everything was fear-oriented, and I just looked at history. I looked at history. I looked at the data. I looked at where we're at. I looked at the why. Why are they dropping rates? And in my head, it was like, I don't think this goes down. And if it does go down, it'll be momentary. Okay. So I'm going to read today's news because these are the futures, right? The stock market opens up in 23 minutes. So, and then I'm going to go over some of this historical rates data, and we're going to see why analysts are wrong a lot, okay? And why, just like my father, you should have stayed in your investments. You shouldn't have sold because you never really know what's going to happen. Okay, I'm done venting for a second. Let me read. I might be able to catch my breath. U.S. stock futures are falling as investors brace for the triple witching event today. Nike shares are rallying. Thank the Lord. I've been stuck in Nike for 4 years with some clients. It's been miserable. So I'm very happy to see that it's finally rallying and we can make some gains for people. Nike shares are rallying in pre-market trading after the sports apparel giant said it is replacing Chief Executive Officer John Donahoe with a former executive. Wow, I thought they would give us the name. People really liked that. Shares were up like 10%. It was like 9.8 or something. Pretty crazy. FedEx shares are sinking after the shipping giant slashed its full year outlook. Apple is selling iPhone 16 without its AI, its AI features, which makes no sense. That was the whole big thing that they were trying to implement. And WMG, Warner Music Group, is now planning on a greater number of layoffs in an updated restructuring plan. Here is what investors need to know today. So U.S. stock futures mostly edging lower as triple witching looms. Nothing else is important. We already covered everything else. Okay, so look, let me just go over real quick. I asked ChatGPT, which again, not the most accurate thing, but I also went through and just looked at the history. How does the market react to rate cuts? Okay, I just want to read ChatGPT's response to you, okay? Okay, the market reacts with mixed emotions. Some excitement due to the anticipated future rate cuts and some concern about underlying economic risks. Chair Jerome Powell emphasized that this rate cut was not a response to a crisis, but a proactive move to recalibrate policy in a less restrictive environment. More cuts are expected this year as the Fed looks to support economic resilience. Okay, that's about this current rate cut, which I think is fair. The why of the Fed's rate cut is very, very important. And sorry guys, if I'm saying rate cut and you don't know what that means, the Federal Reserve, which is essentially America's bank, dictates rates. So usually it's a range. So they'll say, hey, you're allowed to borrow money, these massive companies, right, from each other, from them, at a rate. Maybe it's 5 to 5.25. And that's the rate at which you can borrow. So if you borrow $100, you have to pay back 5.25% on top of it. Loan math gets difficult, but for the sake of understanding, 5.25% of $100 gets paid back to the loaner. So it gets more complicated and less complicated, but just for the sake of understanding, that is all the Fed rate cut is. That's all the Fed rate is. It's the government, the Bank of America, not the company, but actually America's bank, telling the companies, hey, at this rate is the rate at which you can borrow. And when that gets lowered, okay, companies borrow more money because it means it's cheaper to borrow more money. And when it gets raised, it means that it's more expensive to rent money. So that is, it's big, right? If it's cheaper to borrow more money, people borrow more money. If it's more expensive, people don't. So here is the historical, how ChatGPT says historically rates affect things. So historically, rate cuts can lead to short-term market volatility, but tend to support stock market growth as lower rates stimulate investment and spending. However, it has also raised concerns about the broader economic outlook, including potential risk in areas like employment and inflation. Okay, let me just say that nobody knows, not me, not Warren Buffett, not anybody knows what's going to happen in the stock market, okay? The economy and the stock market are two very different things. Now, they're correlated, but they are not causated. I think that's the right way to say it. The market and economy sometimes affect each other and they sometimes move in the same direction, but it's not necessary that the economy has to go down and the stock market has to go down. We're seeing that right now. The economy is very expensive. Okay, right now things are expensive, but stocks are doing really, really well. Okay. And inherently you would think, and most people don't think this way, but when stocks are expensive, it's just like going to the store and things are expensive. So imagine stocks are just all the food items at the grocery store. Okay. When Nvidia is doing really, really well, it's $10. Okay. Eggs are $10 when there's inflation, when things are very, very expensive. Okay. And when things are cheap, right? The stock market crashes or there's a downturn, eggs are $3. Okay. Nvidia is $3. And if you look at it like that, then you're not afraid of the volatility. You go, ooh, eggs are cheap. Let me buy a bunch of eggs, right? People do that with gas. Like, oh, gas is $2 a gallon. Let me go spend $5,000 and just have gas saved up, right? So that is how I would say I look at it. Definitely, I look at it that way. How I try to encourage my clients with a long time horizon to look at it, and how most people should. But most people don't look at it that way. They look at it like, oh, the stock market just needs to keep going up. It needs to keep going up. But that's not how things work in the grocery store, right? You're still purchasing something. Just like you're buying eggs or gas, you're buying a stock. And there's price fluctuation. So that's something to consider. That's how they're different also, is that a stock goes up and down and creates value. When you buy an egg or you buy something in the grocery store, its value it's used up. It's done. So that's another thing about the economy and the stock market that's different. Economy is goods and services that tend to get used up. And then the stock market is the company producing those economic goods and services. Okay. I know it gets confusing, but they are different. So you can be in economic turmoil, like I would say we are, and the stock market can be doing really, really well. But when that happens, there tends to be volatility. There tends to be rate cut decisions. There tends to be just basic confusion in the air. So let me read what's happened in the last 5, 6, 7 rate cuts. Okay. And the reason I'm doing this, and I know I'm 2 minutes over, is because every analyst that I saw, maybe 8 out of 10, was all negative. They thought the immediate reaction, we're talking 24 hours after rate cuts, is going to be boom, 5% drop, 10% drop, which I had told clients, if that happens, immediately we're buying into a growth fund. We're gonna ride this wave because I know in my head it has to go up. Now, again, we're not always right, but some of the times we are. So let me read what's happened here. So in 2020 with COVID, right? Stocks plunged initially as the pandemic drove economic fears, even though the rate cuts provided eventual support for the market's strong recovery in the latter half of 2020. Okay, that drop happened, I think, in March. By July, we were at all-time highs. Or maybe not July, but the fall. Okay, fall of 2020, all-time highs. 2019, 3 rate cuts from July to October. Stocks performed well, climbing over 10% in the months following the first cut, as the market interpreted the cuts as a mid-cycle adjustment rather than an economic emergency. Again, continued on up, drop in 2020, up to new highs at the end of 2020. 2008, this is the housing crisis. The market dropped sharply after rate cuts because the economic damage was deep and cuts were insufficient to offset the severe recession. That was at the end of 2020 or 2008. And let's go to 2007, 2008. Initial cuts for the financial crisis did little to prevent the market from falling, as the cuts were a reaction to mounting financial instability. Okay, so by 2012, all-time market highs. Actually, I think it was 2011. Sorry. We were back to where we were and higher. Okay, so what is that? 2.5 years? Jeez Louise, people talking about this. 2.5 years. You can't wait 2.5 years in the market. And I know it's hard, but 40% of people sold out their 401ks during that time. So, just crazy to me, the emotional investment. Okay, 2001, the dot-com bubble. Cuts failed to stop a prolonged bear market as the economy entered a recession. True, by 2003, again, back to where we were before the bubble. 1998, the Fed cut rates and the market rebound strongly within months, with the S&P gaining 28% in the year following the cut. Okay. I bring up all those different rate cut situations to tell you this, is that nobody really knows. Okay. When I think about it, the why of the Fed matters. So this why, according to the Fed chair, Jerome Powell, was that, hey, look, we see inflation and jobs reports slowing down. So now we can flush more money into the market. Okay, there can be more money now put out there, and it'll expand the economy, is the idea. The more money in circulation means the more money can be spent. Okay, and there's not a tighter supply on the money. Now, the one thing that comes with this is volatility. Okay, when there's a lot of money at play, that means there's a lot of money to lose. So there will be a lot of reactionary selling, reactionary buying. Okay, we have wars going on. We've got 2 wars going on. We've got a wild presidential year coming. The vote is coming up in 2 months. Okay, we have no idea. No one knows what's going to happen. It's going to be crazy. There's going to be volatility. And depending upon where our clients are at. So if we have an older client and they're looking to retire in a year or 2, they're not all in the market. Okay, a lot of their money is in fixed income. We can sort of gauge, if not guaranteed, we can gauge a range of their return pretty successfully. Okay, because they're not in high risk investments. If you have 10, even 5, 10, 15, 20, 50 years left, you're in the market for us. Okay, you're playing the game. You have to play the game to win. And if you try to time it, I only know one person who's ever really been successful at timing it. Only one, and it was Warren Buffett. Okay, and he started learning about stocks when he was 9. So he has an extra 11 years on me in really understanding this stuff. And he has 11 years, he has 80 years on everybody else. Okay, this guy, he got lucky once or twice with timing. Okay, he got lucky with Apple, and then I think he got lucky with Waste Management. I got to double check that. But when you invest in companies, you got to just say, look, this is the long haul. Okay, when you invest in the market, it's the long haul. So nobody knows about these interest rate cuts. Interest rate cuts historically are good. Yes, there's volatility, and if there's a dip from the market rate, like today, if there's a huge dip, I'm trying to buy growth funds. I am trying to get people in the market because there's probably going to be, I mean, think about it. Nobody wants to inherit, no presidential cabinet wants to inherit a failing market, okay? And no standing cabinet wants to have a losing market, okay? So there's a lot of incentives politically, and the economy is ripe for an inflation slowdown. And once that happens, that means that the expansion for the market, for the economy can occur. Okay. So again, don't be fearful, be excited. And you got to know that there is probably nothing, not always, but probably nothing that's going to happen to the stock market as long as you have time. Okay. And I view time as 3 to 5 years. There's probably nothing outside of a Great Depression type of situation that's going to make you lose all your money. Okay? Again, time heals all wounds. That is a true saying. Historically, it's been that way. And again, Warren Buffett's quote, which is one of my favorites. I have no idea what the S&P 500 is going to be in 10, 20 years, but I know it's going to be higher. And that's tried and true and sings aloud. So, look, I've been ranting. This is my longest episode in a long time. It's because it's early in the morning. It's because I'm fired up. Guys, that is it. Okay, I hope you enjoyed this episode. As always, invest early, invest often. We'll see you next week.